All right, today we are diving into a really fascinating corner of the financial world. And look, we're not talking about trying to predict the future or guessing which way a stock is going to go. Nope. Instead, we're going on a hunt. A hunt for these temporary little glitches in the market, tiny moments where logic just kind of seems to break down, and that creates a window of opportunity.
So let's just jump right in with the central puzzle of this whole thing. I mean, really think about it for a second. How is that even possible? It feels like it should break some basic law of, I don't know, reality, right? A car is a car. An apple is an apple. But as we're about to see, the market, well, it isn't always perfectly in sync.
And here it is, a perfect concrete example of that puzzle in action. So imagine you're looking at your screen and you see this. Over on exchange A, one Bitcoin costs exactly $30,000. Okay, but at the exact same moment, you look over at exchange B, and that same Bitcoin, the identical asset, is selling for $30,120. That $120 difference, that's the glitch. That's our opportunity. Now, there's a name for taking advantage of this exact kind of situation, and it's called arbitrage trading. It's a strategy that's built entirely, 100%, around these temporary little price caps. The goal isn't to bet on whether Bitcoin is going up or down in the long run. It's simply to grab the difference between those two numbers we just saw. That's it.
And I love this quote because it really gets to the heart of the philosophy here. Arbitrage traders, they're not fortune tellers with a crystal ball. Think of them more like detectives. They are scanning the present right now for clues that the market is just momentarily out of whack. They're capitalizing on a temporary reality, not trying to predict a future one.
Okay, so we've seen the puzzle, we've got the name for the strategy. So now let's walk through exactly how a trader would actually capture that $120. This is where the theory gets real. First though, a key piece of vocab. That price gap we saw, it's not just a glitch, it has a technical name, a market inefficiency. It's just a fancy way of saying it's a moment when the market isn't being perfectly efficient and prices for the exact same thing are briefly out of sync. This inefficiency is the blinking green light. It's the signal that an arbitrage opportunity exists.
So how do you do it? The execution is everything. And the key word, the most important word here, is simultaneously. You have to do two things at the exact same instant. As you can see, you buy one Bitcoin on the cheaper exchange, exchange A, for 30 grand. And in that very same nanosecond, you sell one Bitcoin on the more expensive one, exchange B, for $30,120.
And boom, just like that. The result is an instant profit of $120. You see, by buying low and selling high at the exact same time, the trader has locked in that price difference. It's considered one of the lowest risk ways to trade because you never had to care if Bitcoin's price was about to crash or rocket to the moon. All you needed was for those two different prices to exist for a split second.
But here's where it gets really fascinating. The very act of doing this trade helps fix the problem that created it. All the buying on exchange A nudges its price up, while all the selling on exchange B pushes its price down. So, weirdly enough, the trader exploiting the glitch is actually a force for stability. They're helping the market correct itself.
And this whole process perfectly illustrates our next vocab term, convergence. As more traders spot and jump on this same trade, the two prices are pushed closer and closer and closer together until, poof, the gap, that market inefficiency, disappears completely. The opportunity literally vanishes because traders took advantage of it.
So how does this become a repeatable process, a day job? We've looked at one very specific example, but let's zoom out now and check out the general playbook for anyone who wants to think like an arbitrage trader.
It's pretty much a 5-step loop that just runs on repeat. First, you're on the hunt. You are constantly scanning markets for those price imbalances. Step 2, you pounce. When you find one, you execute those simultaneous buy and sell orders, just like we saw. Step 3 is the payout. You capture that price difference's profit. Then comes step 4, which kind of happens on its own. You just wait for the market to converge and close out the trade. And finally, step 5. You do it all over again, hunting for the very next glitch. Now, this core idea of exploiting price differences, it isn't just limited to one crypto coin on two different exchanges. The concept actually expands into a whole toolkit of related strategies.
So, for instance, divergence. That's just the name for what creates the opportunity in the first place, when prices are moving apart. But you can apply this logic to more than just one asset. That's where something called pairs trading comes in. You might look for a similar gap between, say, two big oil companies and bet that their prices will snap back together. And then you got statistical arbitrage.
I mean, this is the supercharged high-tech version of it all, using powerful computer models to find these tiny opportunities at lightning speed.
Now, this all sounds pretty great, right? But there is one massive challenge that defines this entire field. It isn't just about being smart, it's really about being fast, incredibly fast. You see, these price gaps we've been talking about, they can appear and disappear in the blink of an eye. We're talking milliseconds. If a trader is too slow, if their computer is too laggy, or even if their fees are too high, that profit is just gone before they can even click the button. In the world of arbitrage, speed is absolutely everything. And that leaves us with a final, really interesting question to chew on. In a market that's just dominated by these automated, high-frequency trading bots all hunting for the exact same thing, where can these glitches, these little inefficiencies still hide? It's this constant cat-and-mouse game, and it just proves that even in our hyper-connected world, the market is never, ever perfectly in sync.